Welcome back to Investing Talk Podcast.
Today we're looking at Jet.AI, a name that's been turning heads not just in the skies, but increasingly in the cloud.
Yeah, specifically in the, high demand world of high performance GPU infrastructure.
Exactly.
And that's really the story right there, isn't it? This isn't just a simple aviation story anymore.
Not at all.
It's a high stakes, capital intensive bet on the future of, generative AI infrastructure. We are analyzing a company undergoing a really dramatic strategic pivot that entirely defines the investment thesis moving forward.
It's a complete strategic whiplash. You're talking about going from optimizing jet charter routes to building data center campuses.
Right, a massive leap.
So our mission today is to give you the shortcut to understanding this rapid transition.
Yeah.
We'll break down the fundamentals of this massive shift. Look at the recent technical trading signals that have made this stock so volatile and dissect the highly complex market sentiment.
Which is really fighting between the old reputation and this new growth story.
It is. And most importantly, we'll identify the key risks and the calendar for when these critical catalysts will actually materialize.
As usual, before we start, subscribe, like, and comment to this video to support the show and ensure you never miss our analysis on these potentially high-growth stories.
All right, let's get into it.
Let's get right into the nuts and bolts of this transformation, starting with what has to be the biggest strategic swing we've seen in the small-cap market recently.
The core of the Jet.AI story is this central transformation. The company currently operates in two segments that they're now becoming legacy segments.
Okay, so what are they?
You've got the software side, which includes tools like CharterGPT and their B2B operator platform.
Right.
And then you have the physical aviation services segment. Now, while these segments provide current revenue, they are now acting primarily as, let's say, the initial engine.
The engine, so generating the cash flow to fund something else.
Exactly. The cash flow that helps fund Launchpad for something much, much bigger.
And that something bigger is the aspiration to become a pure-play AI data center company.
That's the goal.
I have to just reflect on this for a moment. This is a massive capital-intensive jump.
That's huge.
I mean, you're moving from optimizing the highly specialized, highly regulated world of chartered flights to designing, deploying, and managing scalable, high-performance GPU infrastructure.
And then providing AI cloud services on top of that to third-party clients.
We're talking about moving from a niche service provider to competing, even if it's indirectly, with the biggest players in the compute space.
That realization that they can monetize the infrastructure more effectively than just using the software internally, that's the key pivot.
So it's not just a press release then?
No. And the concrete evidence that this is far beyond a simple marketing exercise is the joint venture they announced for a 50-megawatt data center campus.
Let's just pause on that number for a second. 50 megawatts. Because it's easy for listeners to hear megawatt and not really appreciate the magnitude of that.
It's a lot of power.
To put it into context, 50 megawatts is enough power capacity to run a small city. Or, more relevant for the AI industry, it's the kind of capacity needed to run thousands of the most advanced, power-hungry AI accelerators. Think NVIDIA H100s or something equivalent nonstop.
Right. This is not a pilot project.
No. It's an immediate statement of intent. It immediately puts them in a league with established, niche regional cloud providers.
And it requires massive upfront capital commitment and sophisticated planning. This separates them entirely from startups who are just, renting rack space in somebody else's facility.
So that scale is what gives the whole transition credibility.
Precisely. This move positions the company to capitalize directly and immediately on the accelerating and almost insatiable demand for specialized AI computing power.
Which is the fastest growing tech sector globally.
Exactly.
And the implication for shareholders, if this is executed successfully, it's genuinely transformative, isn't it?
It is. It places the company squarely in the hottest, highest growth sector of the global economy.
And it moves them away from the cyclical, tight margin business of private aviation.
This pivot promises a potential revenue trajectory that could far exceed anything their legacy business could ever generate on its own.
The addressable market is just exponentially larger.
It really speaks to management's strategic clarity. While their existing software is valuable, the ultimate scalable wealth generation, it lies in enabling the infrastructure that powers the AI revolution for others.
Making them a platform.
Right. They're aiming to sell the picks and shovels in the AI gold rush, not just pan for gold themselves.
Okay, now let's inject the necessary financial reality and skepticism that comes with any major strategic pivot.
Of course.
When a company attempts a transformation this dramatic, the immediate financials are almost inevitably messy, and visibility is low.
Very low. We don't have specific 2025 10Q or 10K revenue figures, no guaranteed margin details on the available data. That lack of consensus is key.
So you have to acknowledge upfront that profit margins are currently pressured.
They are, and it's primarily because of two major factors. First, the high transition costs associated with, shifting focus.
Okay.
And second, critically, the immediate capital expenditures required to even start the 50-megawatt project.
So this is absolutely a turnaround story. It's heavy on execution risk. It is not a stable, predictable grower yet.
Not by a long shot.
That's the significant challenge for any new investor, right? You're buying into a complex restructuring.
But the opportunity is why the market is paying attention. The AI infrastructure, vertical. It inherently has better structural margins and exponentially faster growth prospects compared to the cyclical nature of aviation.
Which is so sensitive to economic downturns and fuel prices.
Exactly. If they successfully build and, more importantly, secure high-value long-term tenancy agreements for even a small portion of this market,
Their whole financial profile changes?
their entire operational and margin profile shifts dramatically for the better. The legacy business could become, just a minor footnote.
But I'm also fascinated by the internal efficiency story here that kind of overlaps with this pivot. Even as they're deploying all this capital toward the data centers, they are simultaneously refining their legacy operations using their own AI tools.
Right. And that efficiency optimization is the mechanism that allows them to maximize profitability from the old business while shifting focus. It minimizes the cash burn during the transition.
Which is critical.
Precisely. We see proprietary tools that are already baked into their business model, like DynoFlight, which is used for real-time carbon crediting.
And regulatory compliance, I assume.
Right. And Reroute AI, their internal fleet positioning intelligence tool. These applications create immediate operational efficiencies through automation.
And new revenue streams too, right?
And importantly, new niche revenue streams, like the carbon tracking component, which they can sell as a service. This could expand future margins and, effectively fund part of the transition internally.
So they're trying to reduce the need for external financing in the near term.
That's the idea. It shows that management understands AI not just as a product to sell, but as a mechanism for their own internal efficient operations.
But that efficiency story will only get them so far against the massive capex demands of a 50-megawatt build.
Absolutely not. And that brings us to the most crucial, non-negotiable date on the calendar.
The earnings report.
Yes. We are operating with limited visibility on the exact financial acceleration until March 26th. That next earnings report is absolutely critical.
And the market will be looking completely past the legacy aviation revenue numbers.
Those are history.
We need to see forward-looking guidance entirely focused on revealing segment acceleration. We need the first real quantifiable guidance on the AI segment.
What's the expected revenue contribution? What's the timeline for the data center JV? And critically, the planned capital deployment schedule. That's what matters.
Okay, let's turn to the balance sheet, specifically concerning cash position and, the biggest elephant in the room for any high-growth, CapEx-intensive story.
The perpetual threat of dilution.
Exactly. We know they recently shored up their financial footing by completing an ATM offering with Maxim Group.
An ATM offering. So an at-the-market offering. For those who aren't familiar, it's essentially a slow, steady way to sell newly issued shares directly into the open market.
Right. To raise capital quickly without the massive price shock of a big secondary offering.
It's a necessary tool for capital-hungry growth companies. It provided immediate cash flow and stability, which is good.
Oh.
But it also increases the share count, which feeds right into those dilution fears.
But we do have some crucial clarity on the current common share count, which is vital for calculating future dilution. Let's talk about the Series B conversion price reset event.
Yes, because this is where a lot of the historical fear came from, and where management kind of drew a line in the sand.
Okay, so break it down for us.
For you, the listener, this is critical. A Series B reset means that investors who held preferred shares were given the right to convert those shares into common stock at a much lower, more recent price.
Which is painful for common shareholders because it effectively transfers value to those preferred investors.
It is. However, the good news is that by pegging it to the January 7th closing price, management finalized the dilution hit related to that specific event.
So we now know the number.
We now know the precise post-reset common shares outstanding, 11,238,147 common shares.
That clarity is undeniably good. In the world of these high volatility small caps, removing ambiguity around the share count is a massive step in mitigating some of that investor fear.
Right. The dilution related to that specific Series B conversion is now a known contained entity. The damage is done, so to speak.
But the fundamental financial issue remains, doesn't it? As you mentioned earlier, funding massive multi-megawatt data center projects is inherently capital intensive.
And perpetually so. The current cash position is supported by that ended ATM, which gave them a short-term runway.
But the ongoing funding needs, especially for the development and build-out of the 50 milliW campus, inherently raise immediate and persistent dilution concerns down the road.
Likely through future equity raises or, high interest debt, one or the other.
And since we don't have detailed free cash flow figures available, the expectation has to be negative cash flow until that data center starts generating significant recurring revenue.
Which could be years from now.
Yeah.
It's also important to see where the current cash was spent. The ATM proceeds were explicitly earmarked for AI infrastructure reinvestment.
So no buybacks or dividends?
No, we are not talking about returning capital to shareholders here. This is purely growth and CapEx-focused spending.
And that necessity maintains the stock status as a high-risk, high-reward proposition. It's based purely on the future value of the asset being built.
And finally, we saw some fascinating and I think highly strategic maneuvering on the executive side that ties directly to potential value unlocking. The near-term debt load appears manageable, which is a relief. But the new executive employment agreements, that's the real story here.
This is where you see the aligned insider interests. Yeah.
Exactly. Management explicitly positioning the company for a major event. Those agreements include substantial change of control bonuses tied specifically and directly to potential transactions involving Fly Exclusive.
That is a powerful and very clear signal.
It is.
Management is directly and financially incentivized to achieve a large strategic outcome, very likely an M&A or combination-driven upside scenario involving that specific entity.
It suggests insiders are actively positioning the company for a major liquidity event that could unlock significant value and maybe provide the capital injection they need to stabilize the 50 milliW build without overwhelming further dilution.
Okay, so that brings us to the most crucial question. If the plan is to become a major AI infrastructure provider, why would a sophisticated client, a hedge fund, an aerospace manufacturer, a biotech startup choose Jet.AI over a massive established hyperscaler?
You mean over Google Cloud, Microsoft Azure, or Amazon Web Services?
Yeah. This is where the thesis either collapses or takes flight. You're telling me a carbon tracking tool is a competitive moat against Google.
Yeah.
Doesn't the sheer capital requirement of a 50 milliW build immediately place them at a severe disadvantage against companies that spend billions a year? How do they possibly beat the volume and pricing power of a hyperscaler?
They don't. They don't try to beat them on price or volume. The competitive advantage, the moat, is rooted in the company's proprietary AI software suite, yes, but specifically the expertise required to build and run that software in a highly regulated, high-stakes environment.
Right. The intellectual property wasn't created in some generic server farm. It was painstakingly developed in the specific, highly regulated world of FAA Part 135 charter operators.
A very unusual and very differentiated origin story for an AI infrastructure company.
So let's look at the specific aviation IP.
You've got CharterGPT using natural language processing for the customer interface. DynoFlight handles complex regulatory functions like mandated carbon tracking.
And Reroute AI, that's the fleet deployment one.
Right. And the FAA Part 135 rules are incredibly strict, audited, and data-intensive. Their software manages complex compliance and tracking under constant regulatory pressure.
That system created high switching costs for charter operators. It protected that legacy market share.
It did.
So the intellectual property is less about the algorithm itself and more about the architecture built around the algorithm to handle complex data security, regulatory compliance, and auditability.
Exactly. When they transition to offering AI cloud services, they aren't just selling GPU time in the 50 milliW facility. They're selling specialized cloud architecture and services built by people who have successfully navigated these high-stakes, highly regulated data environments.
An end-to-end vertical solution.
That's the idea.
So Instead of competing with AWS on generic compute, they're positioned to offer a differentiated niche AI service to industries that prioritize security and compliance over raw cost.
Think specialized medical data processing or financial modeling, or maybe even continued aerospace AI services. This allows them to charge a premium.
So that ability to build highly secure, auditable, vertical-specific AI tools, that's their real competitive angle against the massive generic cloud offerings.
That and the physical commitment to the 50 millibu joint venture. It helps establish a real physical barrier to entry,
It's expensive, but securing large-scale power and land is difficult to replicate.
especially in high-demand markets. They are forcing their way into the physical infrastructure game, which is difficult and expensive for most startups to replicate.
Okay, so that covers the fundamental narrative, the messy financials with that key clarity on the 11.2 million shares, and the competitive moat.
Right, a moat rooted in their proprietary AI software's unique origin story. But a transition this radical and this rapid, it creates intense trading patterns.
Oh, absolutely.
The charts are screaming momentum, but momentum is driven by emotion. So what are the charts telling us on the technical side, and how's the market digesting this sudden massive shift?
Chaos, as you said, is absolutely the operative word, and that's reflected in the chart. The current state is defined by extreme headline-driven volatility. Coupled with these intermittent bursts of bullish momentum, this is absolutely not a quiet, sideways accumulation stock that you expect stable growth from.
No. This is a stock where the previous resistance level is almost irrelevant because the narrative has shifted so fundamentally. It's a binary outcome play.
We've seen specific quantifiable movements that perfectly illustrate this. I
Yeah.
mean, recent history includes a recorded 29% jump in a single day,
A huge move.
which was then often followed almost immediately by deep pre-market dips as quick profit takers got out.
Of course.
Then we saw a subsequent Thursday surge that was explicitly driven by the positive 8K filings detailing those new executive agreements and the intriguing ties to Fly exclusive.
The interpretation of those rapid, large swings is critical for the retail investor.
It is. They imply serious, concerted attempts by momentum traders to achieve and hold higher highs. They signal confirmed breakout attempts.
And you can see it happening with the social media trending and the chat room chatter.
It all suggests a strong momentum recovery potential, driven by this new AI thesis finally overriding the old, stagnant aviation narrative.
And the psychology behind the trading reinforces that fragile, bullish interpretation.
It does. The stock actually rallied over 5% after they had previously withdrawn a public offering.
Which normally signals deep weakness, a failure to raise capital.
Exactly. So why is that resilience important? It suggests that the new support levels established by the AI news are actually holding firm, despite the persistent selling pressure we see.
And that selling pressure stems from two things, right? Profit-taking and the ever-present fear of future dilution.
Always. So the trading pattern confirms that the price action is almost entirely dictated by catalyst-driven news, not by institutional accumulation based on a deep fundamental valuation.
This firmly establishes JTAI as a momentum play.
No question. Investors aren't buying based on traditional metrics like price to earnings. They are buying purely based on the next expected material corporate announcement.
The next 8K, the next JV milestone, or that March 26th guidance.
Okay, let's delve into the actual flow dynamics that underpin that intense volatility. We have detailed records of sharp volume spikes tied directly to the news catalysts.
The ATM completion, and critically, the AI pivot announcements.
Volume absolutely exploded off the historical baseline, sometimes 10 or 20 times its average daily volume.
And the data uses these aggressive descriptive terms like soars Thursday, and explicitly highlights the 29% jumps, which are, quantitative indicators of very aggressive retail interest.
It's driving significant short-term flow, and you can probably see some institutional money testing the waters, maybe taking small speculative positions ahead of that March 26th date.
Looking for confirmation of the AI revenue stream before they commit.
Right. The implication of this heightened volatility and aggressive flow is twofold, and investors need to be aware of both sides. First, it favors large upside breakouts, but only on definitive positive triggers related to the data center or Fly exclusive. These are binary event bets.
And the other side.
Second, if the next 8K or the March 26 earnings report is ambiguous or negative or just fails to live up to the massive hype, the downside will be equally aggressive and rapid.
Momentum traders will exit just as fast as they entered.
Exactly. This is definitively not a stock for slow, patient accumulation or for buy and hold strategies based on current cash flow.
You're attempting to ride the catalyst waves. Timing is essential.
The charts tell a story of a fragile recovery, entirely dependent on external news validation.
Okay, so the charts are screaming momentum, but that momentum is purely focused on corporate catalysts and potential M&A.
That's right. So let's pivot to the qualitative side. I want to know, is the fear factor still dominant here? What are the underlying sentiment scores telling us about whether the market is truly buying this story yet?
The market's focus on this story is laser sharp. We track the relevance of major news items, and every single one had a relevant score of 1.0,
1.0, so a perfect score.
a perfect score. This confirms the intense focus spotlight on JTAI right now. This level of market fixation means that any news, good or bad, is maximized in its immediate price reaction.
That fixation indicates people are actively searching for this information. It's not just passively drifting through the news
Yeah,
cycle.
exactly. But the underlying market mood is still complex. It's fighting against its own history.
Okay.
When we look at the last 5 major headlines analyzed around January 8th and 9th, the weighted sentiment leans neutral to bullish. We saw one headline scoring as somewhat bullish and one as neutral.
And those are the headlines related to the pivot and the executive alignment.
Right. But those only account for the most recent positive developments.
Mhm.
That doesn't tell the whole story of market distrust.
No.
The critical detail for you, the listener, is that the overall 10-item average ticker sentiment score is still mildly bearish at negative 0.20.
Negative 0.2. So that's a crucial distinction. The deep-seated historical pessimism, it's still embedded in the overall score. The market has a long memory.
It does. It's likely due to the stock's massive historical volatility, previous strategic uncertainty, and those persistent dilution fears.
So the market fundamentally distrusts the stock until management proves otherwise through flawless execution. That negative zero point 0.2 score tells us the skepticism is real and deep-seated.
That's the key challenge management faces. That historical distrust is only slowly being overcome by the positive impact of the recent AI infrastructure news and the fly-exclusive catalysts.
Which managed to shift 2 out of the last 5 recent headlines into positive territory.
Right. The mood is clearly shifting toward optimism, but it hasn't fully turned the corner yet.
Yeah.
The bear case is still the default position until March 26th.
Okay, let's explicitly list the concrete bullish signals that are successfully fighting against that stubborn historical bearish score.
We have the stock surging following the announcement of new executive agreements.
The fly-exclusive change of control bonuses.
The critical 50 million data center joint venture announcement.
And the stability achieved by the ATM completion and the Series B reset, which gave us that necessary clarity on the capital structure at 11.2 million shares.
These are all corporate actions that signal fundamental structural change aimed at creating long-term value.
Not just short-term news pops or promotions, it's deliberate action to move into a legitimate hypergrowth sector.
Exactly. But here is a significant factor in market perception that contributes to the high volatility we talked about.
The analyst gap.
The analyst gap. There is a noticeable and important absence of 2025 analyst upgrades or explicit price targets noted in the context of this massive pivot.
So that vacuum means the market is being driven entirely by corporate filings, aggressive 8Ks, and sheer retail momentum.
Institutional coverage hasn't caught up yet. Or perhaps they're waiting until the March 26th report for quantifiable AI segment revenue projections before they issue formal coverage.
And this lack of institutional validation means 2 things. First, high volatility will persist because retail flow is less stable than institutional flow.
Second, it suggests that if the AI narrative holds, institutional money could eventually provide a massive source of stability and liquidity. That's a major potential upside catalyst that hasn't materialized yet.
But for now, we are dealing with a purely catalyst-driven environment where external fundamental validation is missing.
Okay, let's circle back to those new executive employment agreements because they offer some of the strongest qualitative insight into management confidence.
The inclusion of substantial lucrative bonuses tied directly to potential transactions involving fly exclusive is a major signal of intent. This isn't a generalized merger clause. It's specific.
It suggests management is actively pursuing or expects a large strategic outcome, very likely an M&A upside scenario involving that entity.
Their personal substantial compensation is now explicitly tied to closing that high-value deal. Why would they structure it that way if the deal wasn't close to being viable?
It creates a powerful indicator of aligned insider incentives towards a major strategic outcome. They are financially incentivized to achieve a significant liquidity or value event. which perfectly aligns their personal goals with those of current shareholders looking for a premium or a major capital infusion. It's a vote of confidence in the strategic M&A potential.
However, we have to provide a necessary data caveat.
Yes.
We do not have detailed Form 4 cluster buying data, which tracks management's personal share purchases, or 13F institutional accumulation data.
So the positive insight regarding insider confidence comes purely from these forward-looking management contract signals, not from tracking aggressive current share purchases by management.
It's a signal of future intent, not current financial commitment.
Which leads us directly to the unconfirmed yet pervasive speculative catalysts that every momentum trader must monitor closely.
The rumors and major unknowns driving the current price action.
Exactly.
So what's the rumor mill buzzing about that isn't confirmed in an 8K yet?
Primarily, the proposed fly-exclusive combination, which is strongly implied by those executive bonuses. A merger or acquisition there could create a massive integrated entity with immediate scale.
Justifying a premium valuation.
It could. Secondly, the inevitable need for further AI infrastructure funding post-ATM. How they secure that funding is a massive question mark.
Debt, equity, or through the fly exclusive deal. It will dictate future dilution.
Right. And ultimately, the potential M&A upside fueled by the successful execution of the AI pivot. If they successfully land initial tenants for the 50 MW campus, they become an extremely attractive plug-and-play target for a larger player.
So those are the three major unknowns that will determine the long-term trajectory beyond Q1.
The sentiment is clearly improving, fueled by the specific, concrete details of the pivot. But it's still fighting a historical inclination toward pessimism.
Which brings us squarely to the bear case. Let's look at the risks that could derail this entire growth story, and then we'll finalize the timeline for when these major catalysts will actually materialize.
Okay.
The risks here are not merely theoretical. They are baked into the stock's volatile history and its immense goals. The number one most immediate risk, without question, is dilution.
And this risk was flagged in SEC filings and received a deeply bearish sentiment score of -0.42 in the market analysis.
So the market is highly, almost universally aware of this persistent dilution threat. It is the primary reason the stock historically trades at depressed levels.
It is. But here's the critical nuance we established earlier, which suggests a mitigation.
The most immediate dilution risk stemming from past actions is somewhat contained.
Right. The common share count is now clear at 11.2 million following the Series B reset. This suggests the primary dilution event related to that specific reset. The worst of the recent shareholder pain is largely known and priced in by the market already.
That's a crucial distinction for current shareholders. The damage is done on that specific conversion.
The future concern, however, remains paramount. How will they secure the necessary massive capital, potentially hundreds of millions of dollars, to fund the 50 MW data center campus?
That ongoing need for capital is the next and potentially much larger dilution hurdle that shareholders must monitor.
If they issue another large ATM or a substantial secondary offering, the positive momentum from the pivot could evaporate instantly.
Okay, risk number two is simply volatility and confidence. This stock has experienced massive historical price volatility, including an alarming 85% year-to-date drop at one point.
Which signals historically weak and fragile market confidence. An 85% drop tells you investors were fleeing in droves before the AI pivot was announced.
This is far from a stable investment vehicle.
And this extreme volatility is only manageable if the execution of the AI pivot is absolutely flawless.
So the successful and timely achievement of the 50 MW joint venture milestones, securing permits, breaking ground, signing initial tenants, that's the necessary antidote to market anxiety.
It is. If there are construction delays, major cost overruns, or a failure to secure initial tenants, that historical confidence deficit returns immediately, and the stock will likely retest those previous lows.
The AI pivot is the necessary strategic engine to overcome that inherent anxiety, but it's a high-wire act with no safety net. They have to deliver.
Okay, so given the reliance on momentum, we need a firm timeline for when these execution signals will appear.
And the single most important date on the calendar right now is the March 26 earnings report.
And we need to set expectations for that report correctly. The primary focus is not legacy aviation revenue.
No, that will likely be flat or complicated. The market is looking entirely for forward-looking guidance on the AI segment's pipeline and concrete progress updates on the 50 MW data center. They need to show a path to revenue.
And naturally, clear updates regarding future funding and dilution will be key in that report. Management has to provide a credible roadmap for financing the campus build-out.
We need to understand if they intend to use debt, equity, or proceeds from a transaction like Fly Exclusive to finance the construction.
And a major expectation caveat here is that consensus earnings expectations are unavailable.
Because the company is fundamentally changing its business model, nobody knows what to expect.
And this lack of consensus underscores the high-risk, high-reward nature. When there's no consensus to anchor the price, the reaction to the report is usually magnified aggressively.
A positive surprise will be massive. A disappointment will be equally brutal.
So beyond the earnings, there are specific corporate events to monitor through SEC filings. We need updates regarding the potential Fly-exclusive transaction closure.
The one that triggers those executive bonuses, any update on that front will be a major catalyst.
Right. We also need specific investor updates related to the progress of the 50 MW campus groundbreaking ceremonies, permitting milestones, or ideally, announcements of initial anchor tenants.
And inevitably, new SEC filings concerning any additional financing rounds, whether debt or equity, those will need immediate assessment for dilution impact.
And finally, we have to connect the company's fate to the larger macroeconomic picture. The timing of this strategic pivot, while forced by necessity, is highly opportunistic. They're riding two massive tailwinds.
Absolutely. They're benefiting from two significant macro conditions. First, the intense AI sector rotation.
Right. The pivot is perfectly timed to benefit from the current, almost manic, market hunger for high-growth AI infrastructure plays and the high demand for GPU compute power.
Any data center announcement right now is viewed positively because everyone knows the demand is limitless.
And second, the expectations of future rate cuts. If the Fed eases interest rates, it significantly reduces funding costs for smaller cap tech companies attempting these major capital-intensive transitions.
Macro easing could make that 50 mW funding concern slightly less daunting by making cheaper debt available, reducing the reliance on equity-based dilution.
Okay, we've quantified the risk and set the critical timeline focused on the next 3 months. Let's bring this together and give our final verdict.
Based on the entire strategic, technical, and sentiment analysis.
Based on the aggressive, high-potential strategic pivot, the recent clarity on the immediate financial structure, specifically that 11.2 million shares outstanding, and the massive market opportunity, we assigned a bullish score of 6 out of 10.
A 6 out of 10. That is a solid, confident, albeit cautiously optimistic score for a company undergoing such radical transformation.
Right. It's not a 10 out of 10, but it signals that the risk-reward profile is compelling.
So what is the core elevator pitch summarizing the entire investment thesis for the listener?
The pitch is this. Jet.AI's pivot to AI data centers via the 50 MW joint venture and GPU infrastructure positions it for potentially explosive growth in a potentially trillion-dollar market.
And this is a differentiated entry point achieved by leveraging its existing aviation AI intellectual property. That gives them a specific niche advantage in offering secure, high-compliance vertical solutions.
Over the generic competition. And crucially, the recent financial catalysts, the strong Fly-exclusive ties, and the completion of the ATM offering Series B reset have stabilized the immediate financial picture.
That short-term clarity on the share count fuels the upside potential right into the highly anticipated March 26 earnings report.
Which will be the first major reality check for this new thesis. This is a classic high-risk, high-reward bet, where the potential rewards outweigh the risks, provided management executes flawlessly on the data center build-out.
And secures the necessary future funding without overwhelming dilution.
The narrative has shifted from an aviation stock trying to use AI to an AI infrastructure play leveraging aviation IP.
And from a valuation insight perspective, we can reiterate that the extreme volatility and much of the historical dilution risk related to the Series B, it's now largely priced in.
Which offers a compelling entry point for investors specifically seeking an AI-themed recovery play.
Provided they have the necessary risk tolerance for the volatility inherent in a turnaround story that is still dependent on massive capital raises.
So if you are looking for a short-term trade to capture the momentum, the defined swing trade horizon is into Q1 earnings, that March 26th date.
That's the immediate hurdle and profit-taking point, as the results of that report will instantly determine the next phase of trading.
But for those looking for a longer hold, the true investors in the AI pivot, the target is a multi-quarter position.
But that is contingent entirely on the confirmation of execution catalysts.
Specifically, we need to see solid evidence of AI segment revenue growth and demonstrable, measurable progress on the $50 million joint venture in subsequent filings and reports throughout 2025.
Without that concrete execution and clear financing roadmap, the thesis collapses back into the historical volatility trap. Before we close, here's a final thought for you to consider as you track this company. We know the exact common share count is now 11.2 million post-reset, providing great clarity on the current picture.
Right.
Given that starting point, and given the immense expensive nature of building a 50-megawatt data center, how much future funding could this campus require, measured likely in hundreds of millions, before the continuous dilution fears begin to completely negate the potential growth upside?
That's the critical balance.
This is the critical balance shareholders must track moving forward. The rate of growth and value creation from the AI pivot versus the cost of capital required to execute that vision.
Thank you for joining us for this deep analysis on Jet.AI. We'll be tracking the March 26 earnings closely, and we'll be here to break down that crucial report when it drops.
And if you found this analysis helpful and want more high-octane analysis like this, hit that subscribe button right now to ensure you don't miss our next deep dive.